This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast. Hello, investors, and welcome back to the Three Wise Monkeys podcast, a weekly podcast that's all about the markets and investing. Or should I say the Two Wise Monkeys podcast, because this week it's just myself, Andrew Page, founder of strawman.com, and Mr. Matt Joss from mattjoss.com. Our friend Claude Walker not feeling too well today. So Claude, hope you get better soon.
Absolutely.
But Matt, just you and me today, my friend. What are we going to discuss?
Yes, so today we're going to be answering a couple of requests. So the first one is to talk about a company that I think we both know pretty well, which is BWX. Might be familiar to some listeners, particularly the products that they make, which we'll get into in a minute. And then we're going to talk about when to change your mind. So yeah, quite an important topic in investing, not just having the idea, but when you need to be flexible about that. And the last one's one from the mailbag. So as we've been saying, you can send us an email to threewisemonkeyspodcast@gmail.com.
That's THREE.
That's correct.
Yep.
That's correct. Three spelt with letters, not a number. So we had an email come through there asking us about PushPay. So we're going to dig into that. Some tough questions for me on PushPay.
All right. Well, I hope you're ready. But look, let's start a little bit with BWX, which is the company name and also the ASX code. Now, as you said, a lot of our listeners will be familiar with this, but for those who aren't, these guys describe themselves as a vertically integrated developer, manufacturer, and distributor of quote-unquote natural beauty products. So these are beauty products that don't have any of those nasty chemicals in them.
I can tell that you're going to love this after our A2 discussion the other week.
No, I'm actually more on board.
You're okay with this one? Where's this come from?
Yeah, I think a lot of the chemicals that are used in the industry are legitimately scientifically incredibly bad in a whole bunch of different ways.
I don't know if I've seen the studies on this, but all right.
Go science, my friend. Go science. So I guess most people would be familiar with the Sukin product.
Yeah.
That is the big one for them. That's the one that they're most widely known for. But they've also got a host of others, Mineral Fusion, Edward Beale, a few others as well. All of these brands, most of these brands were actually acquired. The company listed back in 2015, only 3 short years ago, and went on a bit of an acquisition binge, really with, a view to sort of, enter new channels and new markets and new product categories. And frankly, Matthew, it was pretty successful in the past 2 years. So we've got financials for 2016, 17, and 18.
Yep.
It was pretty incredible. Sales were up by 173%. Operating profit more than doubled in that time. And the share price just went on an absolute tear. It went a bit above $8 earlier this year. But then it all started to sort of go a little bit wrong.
Yeah, it came unstuck for sure. So this is one that I'd followed for quite a long time and bought shares in. And the thesis for me was more around that core brand Sukin. So that's the one that you've probably seen, now in supermarkets. It was previously only in pharmacies.
Yep.
And it was just kind of clicking, I guess. So this natural skincare segment had been doing extremely well. A lot of people, as you said, for some reason convinced by this science, but not the wonders of A2. And so it was doing really well, and it was growing. It was a very fast-growing segment in an industry that is always quite attractive. So if you look at, the L'Oreal and Estee Lauder of the world, if you get to a certain scale, can be incredibly attractive economics because it doesn't cost too much to make a bottle of the stuff that they can sell for quite a high margin.
Yeah.
So that's kind of what got me interested in it. But what I guess what kind of led to this getting unstuck, this history, was when they made some pretty major acquisitions. And that those just started to, I guess, underperform. So the actual core underlying growth stopped appearing so much. So it was back in February when they released this kind of quite shocking earnings downgrade. And it's one of those things where, as you'd say, the share price is up multiples, right? Several 100% over the prior couple of years. And the flip side of that is that there's quite a lot of expectations built in.
Yep.
And if you have even just a low growth, everything can come crashing down pretty quickly.
And it was a pretty big reversal of fortune. So that incredible growth just took such a U-turn, really. I mean, when they did eventually report their results, the first half profit was down about 31%. Now, when you factor in that there were actual contributions from new acquisitions at that time as well, that shows you that the existing brands and businesses weren't really doing that well.
Yeah, there's always adjustments, right? They have their own underlying numbers on that. And so they did pitch a story that at the time you kind of like going is okay. I think that they were very kind of opaque. They were obscuring the true organic growth. So it was actually tried hard to figure out how much like for like is Sukin growing in Australia, how much is growing externally,
and they didn't disclose that separately.
It wasn't very clear, and I think it was something that just kind of came out on the analyst call where it just wasn't very obvious. And that is something that can be kind of a red flag, I guess, but it was definitely the point where they were on pretty thin ice for me from that point on, because it was a very big change of the thesis. If you think about why you originally buy something, you have to think that through very carefully. And B is just kind of, management kind of discretion didn't seem too good. Seemed like they might not be completely upfront. So.
And there's so much to talk about there. But we also have to, of course, mention the MBO, the management buyout. So we had a consortium of different investors here. It's actually backed by the CEO himself, Mr. John Humble, and the finance director, Aaron Finlay, in partnership with Bain, a big private equity firm. So the share price had come down a little bit. It was around $5, I want to say. And then they launched this bid, which was at a really good premium.
Yeah, $6.60, I think.
$6.60, which just seems like a really good price at this point in time. That was 20 times EBITDA, 20 times operating profit. So for those that's not in the know, that's quite a healthy multiple.
That's a big multiple. Like private equity like to buy things cheap normally. They like to buy it, 8 times what they call EBITDA or they call operating cash. It's not really cash, but they like to buy around there. And this is 20 times. So it's pretty high and, could make sense if it's extremely high quality, but that's really at the upper end of what you'd ever want to pay in that type of deal.
And they obviously thought that they could get value out of that. But of course it was, what are the words that they use? Indicative, conditional, non-binding.
It had about 6 of these qualifying words in the statement. Indicative, non-binding, and it's just every option to like clearly, you shouldn't be taking that one to the bank.
And so they embarked on this period of due diligence. They go into what they call the data room, which sounds really cool, but it's really just a boardroom somewhere, I guess, with a bunch of analysts and lawyers sort of pouring all over. It
sounds super cool. I always imagine there being a lot of like flashing lights and
like those like
10
1950s
screens.
Computers with the magnetic tapes wheeling in the background, etc. The data room. But they didn't like what they found in the data room, evidently, because ultimately the whole thing fell in a heap. Interestingly enough, the market seemed to really pick that one rather well, because generally when there's a takeover, the market price adjusts to that. It goes
almost
right up to the price there. But it was actually at a pretty big discount there. So the market was pretty skeptical of it. And it turns out that turned out to be pretty justified. And so since then, things really, really fell away.
Yeah. So where are we now, Andrew?
Where are we now?
So I believe they've released some recent guidance where I think 70% of their profit's going to come in the second half. And
this is just to get to, again, this EBITDA, this operating profit that is flat, the same as what it was last year. Again, these businesses are growing incredibly well. They're going to have a full year contribution from a lot of these acquisitions, and they're now saying that, well, it's actually going to be the same as it was last year. This isn't per share either, so there's no dilutive aspects to any of this kind of stuff. And as you say, for them to hit that, they will need to make 70% of their profit in the second half. Now, that's a big call. And we've seen this on the market a lot, actually. It feels like a lot lately, where a company disappoints in the first half and then says to investors in the market, it's cool, we're going to make it up in the second half. And it doesn't always happen.
Second half club.
The second half
club. It's
club.
always very sad to find yourself in there. Yeah. Particularly if you already own the shares, right? You're like, that second half will be really good. And sometimes it is, but it's pretty rough.
Here's the thing. Even if it is, right? Yeah. It's a flat result.
Yeah, this is like the worst second half. It's like, hey, if we just double profits in the second half, we'll be back to flat. not good.
But everything at a price, I suppose. So we're talking about that multiple before. That same multiple, that enterprise value to EBITDA is now actually on about 11 times.
Yeah.
It seems pretty cheap. So the new CEO recently at the AGM, you can read the chairman and CEO's address online, and he's basically said, look, a big part of our problem was this management buyout. It distracted all of our team. We were putting a new enterprise resource system into play. We were putting a whole bunch of new initiatives into play, and this takeover just distracted us all, and it made it really hard to do. That's all behind us now.
Yeah.
The businesses are largely integrated. We're seeing some good things in a lot of our offshore markets. And if you kind of think that that's the case and that they're going to have a good second half and that they're not going to go back to that huge acquisitive level type growth. But if they can sort of get anywhere, sort of upper single digit type growth, it's probably pretty cheap now, right?
Yeah, it's an interesting one because it's fallen so far now that it's hard to say that it's the same sell that it was one time.
Yeah. I should have asked you, by the way.
Yeah.
So what point did you sell?
Yeah, so I sold very shortly after the news of the takeover indicative non-binding theoretical proposal came out. Right. So I think we sold at $6.
Okay.
Which was, today it's $3.30 or something.
Well
so
done.
It worked out pretty well there.
Yep.
And it was really just around realizing that there's a very good chance that this could not go through. And not just that, but it's also, I think, thinking through the probabilities in each case. So if it doesn't go through, what will that mean? Well, it'll mean there's going to be a huge 6-month-long distraction, and the business will be terrible, and there'll be a new management team that we don't know at all and don't understand. So
all those things that played out,
and all that did happen. But there was never an assumption they would. It was just there's a reasonable chance of that, and you're pricing that in.
We'll come back to that. Actually, that's a really good point for when we talk about sort of thesis creep. And when you change your mind.
Thesis creep. So for me, it's like interesting now, but it's a very different thesis. It's a very different idea. So we talk about thesis, which just means why are you buying the stock, basically.
Yeah.
And to me, it's a very different company to the one that I looked at, which was growing extremely fast, like 25 to 30% a year, and had kind of tapped into this fast-growing market segment, and also a lot of international buyers. So Chinese shoppers were coming here and buying them up.
The Chinese market.
Yeah, which was, I think, a lot of people's driver of this is a lot of fund managers saw, Bellamy's and A2 milk and infant formula, and this was definitely a hot product that was getting sold out at pharmacies around Chinese New Year time. And
there was a time when any company that mentioned China, it automatically got a premium just 100%. Because of that.
Yeah, and it's just not the case now. And so now it's going back to the kind of boring real world of having to grind out, getting new distribution and all that stuff. And it could be cheap. It's just not my cup of tea. I like more the fast growing type of companies. That's where I like to focus.
Would you call it a turnaround? It's hard. Well, earnings they're not gone backwards at any point.
Yeah.
And perhaps potentially resuming growth. So maybe turnaround's not the right term for it.
I guess if they bounce out of this, it would kind of be a turnaround for me. It's not like the worst turnaround. It didn't turn fully 180.
It didn't collapse and then have to rebuild. But it sort of stalled.
It is a rebuild of strategy though, because I remember when there was some folks that were negative on it and kind of saying that this company is just going to keep acquiring and keep doing this. I never saw it, but it did end up happening exactly like that. But that I think that now they have to completely change the strategy so that they're focused on building organically, which is very different to the other management team, and just playing a more conservative route. So
interesting when you say that with the driver there. I noticed that a lot of the criticism early on was that the management's remuneration, their performance bonuses were tied to EBITDA. Again, this operating profit,
EBITDA,
which is a bit of a side note, is always a very interesting thing for an investor to look at, because basically, what Charlie Munger tells us, and makes just a hell of a lot of sense, is that incentives matter.
100%.
And if you're going to get a big fat bonus by making EBITDA a lot larger,
you're going to make EBITDA larger.
You're going to make EBITDA larger. And how is the easiest, quickest, fastest way to make EBITDA bigger? And that is just to buy another business. And again, it's got nothing to do with number of shares on issue, especially when your shares are trading at a nice high premium. You can raise a whole bunch of capital on market, or you can just pay with shares, and it's very, very easy to do. But the history of the market is littered with the remains of businesses that have gone on acquisition binges.
Absolutely.
And they just haven't had that underlying organic growth, or they haven't been able to integrate it well, and this has not sort of worked out very well at all.
Yeah.
So
it's a trap.
Is it a pass for you?
Yeah, it's a pass for me. It's just not my style box, I guess you'd say. It's not the type of company. If it was much cheaper, I still have my value roots.
Yes. Yeah.
But it's not for me now. If I saw that the company started to turn around on growth, though, which should be part of the playbook, right? After this 70, if they can deliver this 70% in the second half, then they should be tracking pretty well in that half. And if they can do that again for another full year, they should be doing pretty well.
Yep.
So that's where I'd probably get more interested. But again, I just need a bit more upside for me.
I'm always a little bit, again, and listeners of the show would know we have a very strong sort of technology kind of bias, and we need to sort of pick into that a bit more as to why the reason for that is. But I'm always, at the end of the day, these guys are a manufacturer of beauty products. They're up against Unilever, they're up against Colgate Palmolive. The asset that they have really is brand.
Mm-hmm.
And when you've got brand in the retail space, I mean, consumers are super fickle. Sukin came out of nowhere.
Yeah.
Right? It came out of nowhere and was this huge phenomenon. And I'm not saying that it's going to die tomorrow, but it wouldn't be a surprise if it did. Maybe it'll go on to incredible things, but that space can just evolve so quickly.
Yeah.
And so, without that brand, then it's a race to the bottom and very, very thin margins and all of that kind of stuff. So for me, it's also a pass as well. I did put a valuation on Strawman today, in fact, when I was having a bit of a look at this. I think it's probably around about a fair price, not cheap, not expensive, if you believe that they can get this thing back on track. And as I say, grow at that sort of upper single digit, maybe 10%, 11% type growth rate, then it's a buy. But I do not have the conviction to back it at this stage. And like you, I need a much bigger discount to get interested.
Yeah, I'm with you. And I think that's a really good point around the brand, because it doesn't take too long for a competitor. All the competitors have natural products like this too. It's not like they're the only ones that can do it. So you need that barrier.
And they've got scale and other advantages as well. So okay, so that's a pass from the two of us as well. And of course, we'd always encourage you to sort of challenge us on that as 100%. Well, because
I'd love to. Yeah, write us in. Let us know why we're wrong.
We could be wrong. It happened once or twice before, didn't it? So it could happen again.
Absolutely,
mate. Let's talk.
Speaking of when we're wrong, when have we had to change our minds?
Well, why would the trouble? I think, and it's interesting. It seems as though often in our society, particularly in politics, people who change their mind, it's kind of flip-flopper, you've got no conviction. We talk a lot of the time about when it comes to investing, you've got to have conviction. There's going to be volatility, there's going to be scary times. If you're going to jump at every shadow, you're not going to do well as an investor. And yet at the same time, we're sort of saying it's really, really important to change your mind. So give us a bit of a feel for why and when we should do such a thing.
Yeah, it's a really big topic, and I think you're right about the flip-flopper thing. I think that we have this bias that our monkey brains want to just see someone who's strong and never changes their mind.
Certainty sells. Right.
Certainty sells, as we see when we go on TV with other people we're on with.
Yeah.
You don't need to nuances and interesting, right? People don't want to know maybe this and maybe that.
I've gotten plenty of hate mail over the years of you said this and now you're saying that.
Yes.
How dare you change your mind?
So I think that's important, but you don't want to blow with the wind either. So
True.
You need to have some bedrock. At least my approach is some bedrock on which you build your investing.
Yep.
And some kind of decision framework around that works with it. So for me, that's I'm quite heavy into valuation. And thinking through the business model and competitors and that kind of stuff. But it can be different for different people. The key is that you have something to base yourself on, so you're not just swinging with the market's gyrations and mood swings. So there's a few things for me. It's about selling quickly when a thesis is broken. So when, as I said, think through why you own something, not just because it's going up.
Sounds stupid when you say that out loud. It's sort of like duh.
Yeah.
But it's actually fairly rare.
It's super rare. It's rare even with professional. It's rare with professional investors. I think even as astounding as it is, they might have some story that they might quickly mention, but I think a lot of them,
to use the parlance.
It's very common for people not to really do that work and have a very clear understanding of why they own things. There's a lot of trend following, and when I say trend, I mean following the herd of other fund managers, that kind of thing. So I think that's a really key one for me, and I think another is thinking probabilistically, which I touched on before. So going back to our monkey brains, I think our System 1, which is the idea that your quick reaction monkey brain likes to think things are either going to happen or they're not. So it's either there's no chance that that it will rain tomorrow, was raining last week or whatever.
Right.
You don't think about that then maybe it's a 25% chance or a 40% chance or a 70%
Very few
chance.
things in life are 100% certain.
Exactly.
Yeah.
But our brains, like,
particularly in the markets.
yeah, we need to make quick decisions.
Yeah.
To, like, you don't think, oh, there's a 20% chance that lion's going to eat me. You need to think, oh, there's a lion.
I'll take those
It's
odds.
going to eat me. I need to run. And so that's part of what we're doing. But we have a different part of our brain we can elevate and think through things probabilistically. I think that's key. So that BWX is a good example for me. It's not just, I didn't think it was the most likely outcome that the takeover failed because it had management backing and Bain and everything else.
Yeah.
But it was probably about 40% for me, which is actually pretty high when you consider how much the downside would be.
Yeah.
And that was enough to tip me over the edge.
Yeah,
So those are two of my biggies.
I 100% agree as well. And again, it's not like, when you say 40, it wasn't 39.653%. It is a guess, right?
Yeah.
But at the same time, you have to look at what are the different possible futures, roughly which one, do I think is more likely than the other. But not just that, let's assume that, scenario A occurs. What's the likely consequence of that? If scenario B occurs, so if you see a lot of situations in the market where it might be a high chance that something happens, maybe 60, 70, 80%. But if the upside is 5%, and if that other 20% means that it's going to fall 90%, that's a really dumb bet.
That's a bad,
no
bad
gambler is going to make that
100%.
bet.
Yeah,
and I'd hate to equate investing with gambling, but it's a lot of parallels there as well. So I 100% agree with you on probabilistically thinking things through. In terms of that thesis, I think writing it down is super, super important. I think when you write something down, it forces you to actually
it makes you realize how little you know. I think
a
often.
great tweet on that today from Shane Parrish. I don't know if you saw that from Farnham Street blog.
Yeah, it makes you realize the process of trying to write it down makes you realize how little you understand it often, and then it forces you to understand it to a level that you can explain it to someone else.
And if you can't understand it after doing that as well, I think a lot of the time we feel as though we have to reach a decision. We have to. It has to be like a strong yes or a strong no. Or I know I get criticized for this, but I'm really, really big on just saying I don't know and just putting things in the too hard basket. There's 2,000 stocks on the ASX out there. Why am I going to stuff around with things that I kind of feel I sort of maybe have a grasp on when there are other things that I'm never going to have 100% certainty on, but I can have a much, much higher degree of certainty on as well. So just that very act of writing it down. And when you're writing it down, you're also saying, I think what's important is, what are the conditions under which I recognize this as being broken? So
that's the key.
Do you know what I mean? So people, like, selling is hard. I'd say selling is harder than buying. And generally speaking, when you're in a scenario where it goes both ways, the share could be like surging super high, or it could be just crashing low, and you're going to make dumb decisions in that frame of mind. If you've got it written out in advance, like if this does not happen, that constitutes a broken thesis, or if this doesn't happen, I'm going to sell out. It's there in black and white, and it forces you to be much, much more honest with yourself.
Yeah, 100%. So that for me with BWX, when we first bought, had plenty of notes on it, and it was 83% of sales were coming from Sukin.
Yeah.
And all of my thesis was around Sukin.
Yeah.
And there's kind of a risk section, which is if they start making major acquisitions that don't go too well, that would be a big risk.
Yeah.
I didn't think that was like just the last risk that I mentioned.
Yeah.
And it turned out to be exactly what happened.
Yeah.
I wish I'd noticed even earlier, because I could have sold at $8, not $6.
Right.
And so that, could have gone back and done that. But I think it is super valuable when you do need to make that tough call. You need to go back and read your original thoughts on it.
Yeah.
So
you know what's worth mentioning there as well? So in this instance, you were right to sell, but there is another parallel universe out there where you sold and the takeover offer went through, and then they went on to, or perhaps they just fell through, but it went on to greater and greater things. And it's easy to sort of reflect on a scenario like that and go, I did the wrong thing. Now, at one level, you do the wrong thing, but in terms of process, you did exactly the right thing.
Yeah.
And I think investors shouldn't beat themselves up too much about that. If you've followed a very, very strong process and it still turns out to be the wrong decision, you should make that same decision again and again and again. You did the right thing, it just didn't lead to the right outcome.
Yeah, it's just like poker or anything else, right?
Yeah.
If you go all in on one spin of the roulette wheel and happens to get it, doesn't mean that you're smart.
Right. Is there a roulette wheel in poker?
I'm mixing metaphors here. I'm mixing metaphors. So I think that's really good. And I think isn't this kind of like why you created Strawman, Andrew? If I give you a chance?
Well, part of the reason. So one of the interesting things is that we anyone can jump on there and make recommendations, but we actually force people to write a reason
to battle
down.
each other.
You know,
Yeah, right.
it's two investors
fight for the-
until one investor leaves.
Yeah.
No, you can't put a recommendation in without writing down a little bit about your thoughts, or at least endorsing those of another
Yeah,
person.
nice. So you're forcing good process.
It was a hard decision, frankly,
Yeah.
because everyone will always tell you.
People
when it
don't always want to do that, right?
No, it's
And
hard.
so-
Anytime you're adding friction to any kind of online process, it's
Yeah.
it's a bad thing. But it was a very deliberate decision because I frankly think if you're not going to be bothered, and it's not like we have make you write like a 2,000
Yeah.
word thesis here. It's just like you write one. We've got one member who just writes growth, or, you know, but you've got to put down a reason for
Yeah.
doing it for the community, but also for yourself. And I think
Yeah.
it's super, super important.
It's very good practice. I wish there was like some little thing that popped up whenever I went to hit buy.
Yeah.
and said, "Hey, have you done adequate research on this? Have you ticked these boxes?" Yeah,
It's
that'd be
really
quite a cool
useful to
thing
come
have.
back to. Actually, again, it's just
Yeah.
I just do all of my writing online now because I've just got that touchstone to come back and go, this is why I bought it. Has things changed? If so,
Yeah.
I need to make and the other, I think you mentioned this before, is this idea of what's the word? The endowment effect. This idea that when you own something, things change a lot,
Yeah.
and you rationalize
Uh-huh.
all of this kind of stuff. And I think if you can just do all this kind of stuff, you basically need to approach a decision of holding, of continuing to hold, is best answered by asking yourself, if I didn't own and I had no dog in this fight, would I buy today?
Yeah.
And if the answer is no, then you probably shouldn't be holding.
Yeah,
Right?
you should probably be selling. I think that is the most clarifying question.
Yeah.
Would you buy today if you
Yeah.
didn't own? And a lot of times when you talk to people, they like you can see a relief in their face.
Yeah.
Like their shoulders relax a little. Oh, I don't own this
Yes.
horrible thing.
Yes.
And the clear answer is no, they wouldn't be buying. They're just scared, right, to lose.
They're doing all of those. I don't know. I say they, me.
Yeah, yeah,
We
yeah.
all do
They,
it, right?
us, yeah.
You know,
Um,
we all do it. There's that other evil of investing too, which is anchoring. It's like, well, I bought it at $8.
Yeah.
Now it's $4. You know, it's cheaper. Maybe if I average down, my loss won't seem as bad. I'll feel a bit better about myself. And it's just wrong.
Yeah, there's a philosophy I try and kind of live my life by to a degree,
Oh, yeah?
which is that the hard thing to do and the right thing to do are almost always the same thing.
Yeah.
And I think that really
So
applies
true.
with selling as well. Like
Yeah.
if it's really hard, but you think it's the right, then
Yeah.
it probably is time to do it.
Yep.
Whereas if the easy thing is just to hold on and close your eyes and probably avoid that.
It's just
action
such
if you can.
it very rarely ends well when
Yeah.
you do that process.
Yeah, 100%.
Well, that, listeners, is thesis creep.
Yeah, avoid that.
avoid it.
So thesis creep is letting your thesis change over time
Mm.
and just kind of going with it. So for me, it would be if BWX, I was all about Sukin and then they tried to acquire stuff and I said, I'm not interested in that at all. But then it's like, oh, maybe okay. Like this,
Yeah.
you read a good management presentation, you're okay, my thesis is this now. And you have to be adaptable. It should change with time, but you just can't let it just creep just because management are pushing something on you. You have to be rationally
Do
evaluating.
you know what
these things.
I'm a sucker for? So I'll buy a company, and I'll have a clear thesis,
Yeah.
and it turns out to be dead wrong,
Yeah.
and then the share price falls, and so when my thesis creep
Yeah.
is.
That's a trap.
Yeah,
Man. It's
it's
so
a pretty
dangerous.
shitty company now, but now it's in the price. It's cheap. So it's kind of like I was wrong, but now it's still worth holding on because it's just so cheap. And I've got to be honest with you, there's probably like 3 times that's worked out well for every 10 that hasn't worked out well.
Yeah, I think that the way to frame it should always be, this is what I think the market is very wrong about.
Yes.
Rather than that cheap, because it's we've all been there,
Yeah.
but it's just so easy to just get dragged down that slow decline vortex.
It's interesting you say that about the market being wrong, because I think anytime you buy or sell, you are overtly and specifically
Yeah.
in no uncertain terms saying the market is wrong.
Yeah.
Because it's letting me buy these shares super cheap, or it's it's allowing me to sell at an elevated price.
It's a unique combination of humility and arrogance, I think,
It
to be an
is.
investor, right? You need to be
It
humble
is.
enough to change your mind, but arrogant enough to disagree with thousands of other people.
And you cue all the Buffett quotes out there, greedy when others are fearful and all this other kind of stuff. But the reality is that the market, by and large, usually
Yeah,
pretty
it's mostly
smart,
right.
right?
Yeah, yeah.
It's usually pretty smart. And so I think when you acknowledge that and you take that market seriously, even for things that you just don't get, and you think this is crazy, you've got to treat the other side. If you're a bull, you have to treat the bears extraordinarily seriously.
Treat them with respect.
Respect.
Yeah,
and Munger, again, to quote him, he always say, you've got to be able to argue their case better than they can.
Now that's dominance. I like
Isn't
that.
that brilliant?
That's like, yeah, that's
don't have to
mastery.
agree with it. I mean, obviously you don't, but if you can't articulate the opposite to what you're thinking really, really, really well, that alone is a good reason not to buy.
Yeah. Totally.
Wow. Okay. So let's talk a little bit about.
Let's go to the mailbag.
The mailbag.
Let's get some,
do I need a sound
interaction.
effect? No, hopefully I found a sound
no
effect.
Sound effects.
Can we get Jim Cramer on you, listeners?
What's a mailbag sound effect anyway?
I don't know.
Like I don't know. A door? How do you make it? What sound does a bag make?
I don't know. I don't know.
All right. No sound effects. No sound effects.
Okay. No sound effects.
Cool.
I'm totally putting sound effects in.
You've got mail.
So we had Mitchell. Hi, Mitchell, wrote into us and he said, I've enjoyed your podcast so far. I like the so far. It's kind of like things can still go wrong.
Stay on your toes. Keep it up.
Stay
now.
on track. You're pretty positive on PushPay. That is an understatement. The other day, and enjoyed the talk about inflection points and read Matt's blog post about it too.
Very
which
good.
we should mention that as well. mattjoss.com.
Yes.
Go there. You'll find a lot of really good stuff. Anyway, he goes on to say he went and he started having a look at PushPay as a result of that, and he Googled to check out their competitors and found that there were, wait for it, good research by the way, Mitchell, 61 different competitors in this space, in this church management system space. Breeze and Tithe.ly in particular, he felt looked like pretty strong competition.
Yeah.
In fact, he talks a bit about Tithe.ly. It plays off this built by pastors for pastors type phenomenon. And, compare this to the bio of Chris on PushPay's site, which is, it's a much more a business accomplishment theme. There's no real word there about religious exploits or faith. So there's a bit of a commercial, more of a commercial element to it than a faith-based element to it. He also noticed too, he jumped onto Glassdoor, which is always a nice little bit of a research tool, by the way. For those that don't know, Glassdoor is where it allows employees and ex-employees to rate the place that they used to work.
All those positive mentions from ex-employees.
All those positive mentions. And he said that if you go, and I've done this myself, you go and you look at there and it really sort of paints this picture of a very salesy culture as well, and a fairly high pressure one. So he goes on, there's a few more here, but I think that's the essence of the question here, Matt, is that he makes a really, really good point. Some pretty negative Glassdoor reviews from employees and former employees, a very salesy, very commercial type culture, and just a lot of competitors. What say you to all of that? It was a great question. Thank you, Mitchell.
Yeah, thanks, Mitchell. All right, let's wrap it up.
Oh, we're out of time.
No, it's a very good question. Yeah, so I think he's kind of getting to what's the competitive advantage of PushPay, and I think I love that research that he's done, so I think that's super important. That's very aligned with how I like to dig into the company after you've done all the financial stuff, is just really trying to understand the competitors, which is so often missed. It's really bizarre, like how often you'll have this really detailed pitch from someone. It's like, oh, who's their biggest competitor and why are they better than them? And it's like, oh, stony silence.
Yeah.
Oh, I don't know. It's hard to see that.
Yeah.
Because it is hard work. You have to go out and read a lot of stuff.
It really is. And obviously the competitors have got their own presentations.
Yeah, exactly.
And they're talking a good game.
No one's telling you why they're not as good as the other company.
Everyone's got that chart with market share and how they're going to capture all of it.
Yeah. So in PushPay's example, he found some good examples of competitors that I think we're talking through. So PushPay, as I think we talked about a couple of weeks ago, is focused very much on the large church segment. So they have the largest church in America now with 55,000 weekly attendees.
Man, that blows my mind.
Yeah, it's huge.
And they're teleconferencing some of these churches.
Yeah, some of those.
Too.
Yeah, most of that one would be. And so you'd have one core church and then several up to 8 satellite churches, which would be literally just broadcasting, with a cable connection.
Yeah.
And then there's a lot of people that would tune in online as well. So it's not even attending in person. There's a lot of
Don't
that.
have to dress up for church.
Yeah, exactly.
Benefit there.
So that's the segment, which is churches with over 1,000 weekly attendees that PushPay is focusing on. And that was a very deliberate decision. It kind of actually answers a couple of the questions he had. So previously, until mid 2017, they were also targeting the small church segment.
Yep.
And they had quite a big sales team, which were going out and trying to capture as much of that as they can, and with a sales strategy that was a lot more commercial, I guess you'd say.
Yeah.
You could say negatively that it could be aggressive, but it was more direct, I guess, than just well, there wasn't really, they're competing, I say more aggressive than nothing really,
Right.
because it's not common to have anyone pitch you these things
Yes.
in the industry. So they were doing that, but they decided, they kind of looked at the data and realized that a lot of those small churches actually shut down or they stopped using PushPay because they never really implemented it in the first place.
Right.
So they had quite high churn there, about 20% a year, which for them is quite high.
Is it also fair to, sorry to interrupt, but is it also fair to say there's just not much bang for your buck for every sales person you've got out in the field? They might win 10 churches, but it's far better to go and just win one that's 10 times the size.
Yeah,
right?
or 100 times the size.
Yeah, 100 times the size, yeah.
It's very, that's pretty much exactly it. So it's not a, there's not a linear relationship between the amount of work and the reward.
You're still talking to one sort of decision maker on the other side of the
table.
table.
Yeah, 100%. And sometimes it can be harder. So particularly for PushPay's case. So PushPay is trying to build a very premium, ticking all the boxes, handle all this stuff. And if you're going out to a small church, it can actually be harder to sell because you're trying to sell something they don't need, which isn't a good situation, right? So PushPay moved away from that. They laid off a lot of staff, salespeople that were associated with that segment.
Yeah.
And that, I think, is a big part of the driver for the negative Glassdoor review. So I definitely did look at Glassdoor. It's one of the negatives of the company. Not everything is positive, right?
Yeah.
And that's one that I've been watching. I think the CEO, Chris, has been more active on there, particularly over the last year, replying to almost every negative one that comes out.
Yeah.
And so that's good to see. It was something I addressed directly with them in Seattle. But yeah, so that, I guess the core point there is that PushPay is very focused on that top end segment, but their competitors, particularly Tide.ly, have really expanded into that lower segment, which is just a very different business model, right? So you're doing a much lower cost, but much less fully featured.
Yeah.
And they're kind of, right now, I think they've been growing very fast over the last 18 months because they're pushing into an area where PushPay has avoided or abandoned to a degree. Not abandoned, but they're not targeting it anymore like they were.
Yeah.
So it's left quite a good gulf, I guess, for Tide.ly and others to expand into.
Okay.
But I don't see that they're not competing in these large church segments, which is where the real economics are.
Is there a... Okay, so that's great. And they've still got a lot of...
Hit me with a tough question.
Well,
I feel like
look, there's obviously a long runway to go with those big churches, right? But at a point, assuming they get all of them, they're going to have to push down, right? So does it become, and by the time they do this, maybe these other guys are far more entrenched. Does it become a problem then, or is it just a case of by the time that happens, they'll already be multiples bigger than they are now?
Yeah. So in terms of donations, I think something like 85% of the donations are made by the largest church segment, which is what PushPay is targeting in terms of donation volume.
Yeah.
So you could sign up a lot of individual churches and get some software revenue, but it'd be fractions of what you could get from the large church. But that's one aspect. The other is because of those great economics, you expand to be so large and you can have that reinforcing loop where you are more profitable and you reinvest aggressively as PushPay does. So they have 100 developers working for them.
Wow.
That'd be multiples bigger than the entire company of some of those
That
small
blows
competitors
my
we just
mind.
mentioned. Yeah. So they have 100 developers already and they're looking to expand that by 30% over the next year. They've also got this big sales force. And all that means that over time their product just keeps getting better, right? Because you have more cash flows coming in, you spend that to make a better product, and it just creates that bigger gulf.
Yeah.
I think at a certain point, you could go and acquire one of these smaller companies that has it has a different brand that's not targeted towards the high end. It has a different product, so you don't have to lower PushPay's quality down there or destroy the value you've created by lowering the price or using PushPay Lite.
Yeah.
So you could go and acquire that and probably for a fraction of what you're worth because you've got the bigger segment. And I think that's part of their game plan. I caught up with them actually when they visited Sydney recently, the leadership team, CEO and CFO, etc. And I think that is kind of, I pitched that playbook and they seemed receptive to it, to potentially happening down the track, but nothing immediate. But I think that they are more open to expanding into nearby adjacencies with that big church segment. They're very focused on building a product that people, wouldn't ever want to leave.
Yep.
And they're playing the long game, which is always very nice to hear as an investor. But
very much
so I think it's a really good question. I looked at Tide.ly first myself. It was one of my big humps to get over when I first invested, almost 2 years ago now. And so I think that's a very good thing to look at. And I continuously monitor it. So when this question came through, I went and checked all the stats. And Tide.ly have been doing pretty well, but I'm comfortable with it.
I think we touched on this when we first talked to PushPay, but do you ever envisage a situation where, PayPal or someone decides, hey, this is a big market, we could exploit this, and maybe they go in there and buy up some of these smaller competitors and then bring some of that muscle to the show?
They could, but for them it's just so small. Like we think we have to think in like trillions of dollars for the big competitors like Stripe. That's what they're targeting and doing. Like Visa does many trillions.
So
of
even if
dollars
they were
a year.
successful, it boosts things by 5% or something?
Yeah, but they could do an acquisition. I think for some of them would be the way. Like it'd be much easier than going and building a sales force. So PushPay could sell to them. Yeah, I think that's an option. I think that the company they would consider that for sure at the right price and everything else. It just depends on how well they can build things themselves first and what else they do. So, and over time they're becoming less payments. That's the other kind of wrinkle on that. Is they're becoming more like a church software company. And so it becomes less of a pure play for like a payments company to go and buy them.
Gotcha.
So,
it's all the administration side of things.
Yeah, the admin side, the engagement side. And they actually, when I caught up with them, they're talking about an interesting thing, which is just a donor management system. So it's again the admin side, but it's like all of your donors, including cash and check and everything else, you need a way to manage that and give them appropriate like giving certificates and all the tax side of it. That's something that they're like looking to offer more to become more sticky and all those good things. So yeah.
One final question: what if religion goes away?
What if religion goes away? Yeah.
Okay, that's not going to happen. We better wrap it up there, Matt. Thank you. Very good answer, by the way. I'll give you a pass for that.
All right,
pass. It seemed pretty thorough. Hopefully, Mitchell, it answered or addressed your very legitimate concerns there as well.
Yeah.
And as Matt mentioned before, we would encourage you to write into us. We've gotten a bunch of stuff, and I should just mention on that, we do read everything. We do take it very seriously. We do have a list. So it's the way we sort of weigh it up is, we'll pay more attention to the requests that are more dominant.
Yeah.
If we get 100 requests on one company and one on the other, we're going to favour the former. And if I'm being frank too, there's just some that we are more interested in ourselves.
Yeah, I think we want interesting stuff.
Yeah. And it's our podcast, so we get to decide.
We want.
but
we love that feedback.
We really do. Yeah. And suggestions and all of that kind of stuff as well. So please write into us. That email address again is 3wisemonkeyspodcast@gmail.com. You can reach me on Twitter at sage_Simeon and Matt
at Matt Joss, MattJoass, and mattjoss.com.
And Claude, who is normally here, could be reached at Claude D. Walker.
And ethicalequities.com.
And ethicalequities.com.
And strawman.com for Andrew. He's too good to mention his own name.
Oh, a bit of news. You mentioned 300 developers.
Yeah.
I've got one developer who's part-time.
Is it you?
Yeah, that's not me.
Okay.
I
That's
wish,
good.
if I had my time again, I probably would have done a bit of coding on the side.
Yeah.
But it's been a long time coming, but there is a new skin. It's imminent. I know I've been saying it for a while. It's imminent, Matthew. It's going to come, and it's going to like this site that currently looks like it was built 10 years ago. It's going to look like a very modern, very swish, very
exciting.
Mobile. I'm very
excited.
excited. So we are going to push that up very, very soon. But look, I think that's about it. Any last words?
No, I'd say, get in touch. I love getting those emails through, and rate, comment, subscribe, tell your friends.
Make sure you do that as well. Thank you. I forgot about that one. That does definitely help. We've got 1,000 listens or so on a few of the
podcasts. An episode at the moment.
Great stuff. Super exciting. So
cool.
thank you for your support. We obviously, it's if no one's listening, we're just chatting to ourselves.
So we do anyway.
We do anyway, but we might as well put it on the internet.
People listen.
Yeah, definitely. So look, until next time, thank you very much for listening, and we'll see you next week.
Thank you.